Good morning, Dr. Seetharaman.
Morning.
Having heard on transaction banking and GCC banking trends in the Knowledge Management Forum recently, we would like to hear from you now on trade finance. What are the various modes for settlement of trade transactions?
There are multiple modes. One is the advance payment guarantee, by which you pay before the receipt of goods on behalf of the buyer to the exporter through the collecting bank. So you pay in advance. That's why it's called advance payment guarantee, number one. The second one is documentary credit. Export and importers, they exchange documents. Uniform credit process has been settled in an order by which documentary compliance documents needs to be fulfilled, and accordingly the payment will be made by the importer to the exporter on receipt of goods, clearing the goods and then make the payments, and that's been the trend. And open account is the other way by which you have standby arrangements within the buyer and seller, and the bankers of both the sides, exporter and importer, they have the arrangement to settle.
Could you tell us now about the funded and non-funded facilities provided in trade?
Funded is non-funded is very simple to take it forward. LCs, again, whether it's revocable or irrevocable, revolving, pre-shipment, whatever be the methods you have, the guarantees, and again, those are the acceptances or the ways by which the non-funded. When it comes to funded, you have LTR, letters of trust receipts, and you also give term loans, and you also give the cash in advance at times when it is really required. So the bill purchase is a process by which we will be doing it.
Could you give us some insight on documentary credit?
Documentary credit is the uniform code of practice world over, ever since the banking operates on international trade. So you have LCs, letters of credit, where the exporter consigns the material to the importer. That's part of the trade from a different country. So how do you secure the buyer and seller? That's a process by which letters of credits are negotiable. And the exporting bank at the exporting country where the bank is sitting will insist on behalf of the importing party to the banker who are responsible for it. So there is an exchange of documentations. Those are setting documents by which enforceability comes in. So, but there is a standardization process called uniform credit. That's how it operates in substance. When it comes to LCs, there are multiple types of LCs. One is a revolving LCs. You can have continuing commitments, and you can keep doing, and you also have revocable LCs. Before the transaction gets done, you can terminate the arrangements. That's costly. That's not good for the exporter. Again, irrevocable is you cannot say no. Whatever be the materials dispatched, whatever be the arrangements, you have to honor the payments. It's an absolute commitment we make. So that's irrevocable letters of credit. Like this, there are many arrangements by which the exporters and importers get their payments and settlements.
Dr. Seetharaman, what are the other facilities or services provided by the bank in trade?
There are many facilities. You can have issue of guarantees. Again, guarantees are the indemnity the bank is giving to the third party that on behalf of the buyer, on behalf of the importer, you are guaranteeing to the exporter, this credible customer will be receiving the goods. On receipt of the goods, we will be making the payment. That's a clear commitment again. And there are open letters of guarantees, there are conditional guarantees, there are many types of guarantees which we need to look at it depending upon the nuances of the export-import.
How does factoring operate in the trade segment?
Factoring is an arrangement. It is an arrangement for collecting the receivables. It is a facilitation process by which a factor, that is the institutions which does the payment, is called a factor, and they do it at a discount. They look at the receivables and then offer financing at a discount, say 70% or 80% of the original bills they pay. It can be for many invoices, or it is not, need not be confined to one transactions. And there is a structured method by which it will be discounted. There's a structured method by which legal enforceability comes in. The original authentic documents should be submitted, and in terms of trade, even it's like advance payment. You are making it. I know you're going to collect it. The exporter collect these documents and go to the banker or financier factor, and then collect this money in advance so that its needs are met. At the same time, you have a pricing breakup to make money for the financial institutions which offer the factor.
Could you tell us now about forfeiting and how it operates in the trade segment?
Forfeiting is another form of supply chain financing, I should say. It is for a transaction. It is for the transactions, and the transaction has been set in with the ground rules, and the exporter, supply the goods. In the process, he gets sufficient payment in advance, and you have the materials consigned. Even the buyer can also apply the transaction-based finance for the purpose of the supply chain. So before getting the materials, he gets the payment done, and once the material comes in, he realizes by selling it or other doing the business, and then pay the bank. So forfeiting is a structured form of finance. So factoring and forfeiting are complementing each other. One is for the set of transaction, that is forfeiting. Another one is, irrespective of the transactions, a group of transactions could be for the discounting purpose, improving the liquidity purpose. Factoring is being done.
Thank you for your insights, Dr. Seetharaman.
My pleasure.